Hi, my name is Jerry, and I want to talk about trends. I want to talk about trends and support and resistance. I want to talk about market posture and ultimately how everything is kind of sort of tied together with regard to the market forecast indicator. So we're going to do this with the SPX. This is a 2-year chart. We got a 2-year chart daily, and it's comprised of, all we've got on the chart is some arrows, and we have the 30-day simple moving average, we have the 10-day exponential moving average, and we have some white arrows. A white arrow means that the 10-day exponential moving average has just crossed below from the upside to the downside of the 30-day simple moving average. And if it's an up arrow, it means that the 10-day exponential moving average has just crossed above the 30-day simple moving average. So a down arrow is a death cross, and an up arrow is a golden cross for the indicator. So next thing I want to bring up is let's zoom in a little bit here in a tighter area. I can zoom in right in here. So one of the things that I wanted to mention is that this is a 30-day simple moving average, and that's a 10-day exponential. And what makes these two moving averages so significant is that everybody uses them within the trading community, if you will. So if you want to learn to trade, use those two moving averages. And if you want to jump from days to weeks, use those, but keep the context the same, so that when you do it, you just happen to recognize you're working with weeks, in this case weeks, or in our case we're going to go back to days. I had a 2-year chart, so I'm going to change this back to 2 years. So the significance of this is that if we do this and we look for highs and we look for lows in the market, we can see some interesting things. So let's just zoom in on this particular area. So if you zoom in close enough, you can start to see how the trends actually change. So here's a case of where we have a high, and at some point it goes down. So if you call this a high and you go down and then it changes around and go back, this is a high and this is a low. And then when it starts to trend again, it goes up. Since this high is a little bit higher than that guy, the previous high, this is a higher high. And likewise, when it rolls over and it goes down, this is a low, but since it's a little higher than the previous low, this is a higher low. So in an upward trend, we're going to look for higher highs. Here's a high. The next high is right here. This is a high, which is higher than that guy. So it's a higher high. And over here, this is a low, but it's a higher low. So it's a higher low. So you say, well, geez, that seems pretty obvious, but that's the definition of an uptrend. You've got to have higher highs and you've got to have higher lows. And if you don't have that, then you don't have an uptrend. And likewise, in a downward trend, you're looking for, here's a high and here's another high, next high in there. This is a lower high and then a lower high. So this is a downtrend in here, and so as you keep finding it, it's going down. Here's another down one, and then finally it comes back up. So this area in here is a downtrend because it consists of lower highs and lower lows. So here's a low, there's a low, there's a low. And in this case here, this is the last lowest low, but when it finally turns around and goes up, the trend reverses, and now we went from a low to a high, which is no longer, the previous high was over here, so now this is a higher high. There's the previous high, and there's a previous higher high. I know it sounds like I'm talking in circles, but that's a critical element to understanding that you're looking at these trends here, and these points here where it turns around, those are inflection points. So these inflection points are kind of what was one of my things that I first opened my eyes to. I said, when do these events actually happen? And so I got to looking into the market forecast. Go to the next guy, and we're going to talk about these things. And it turns out that they happen at critical areas all the time. Same areas, significant. So if you look in here, we happen to be looking at a 1-year chart. Same for SPX. And if you just look here where these critical inflection points happen, when they flip to the upside, they're going to be sitting in certain areas. So here's one where it turns around. Here's another one. Here's the next one where it turns around and goes back the other direction. And then it turns around again. And then it kind of jances around here, but it makes another turnaround. And it turns out, if you notice in here, all of these inflections to the downside happen in the green area. So here's a green spot, and then when it turns around and finally goes the other direction, it's in a red spot, and then green, and then red, and back and forth. And that's kind of the way it works. And it turns out these areas in here represent the market posture, and they are tied to, if you look at the green areas, you just flat refer to them as a strong bullish posture. That just means things are favorable for for having higher highs and higher lows. And when it goes to be negative, it means that it's highly favorable for having lower highs and lower lows. So as you look at this thing, so we've got strong bullish posture. We have a strong bearish posture for red areas. So strong bullish posture is green areas. Strong bearish posture is red areas. Weakly bullish posture is kind of these less red or pinkish areas, so to speak. And these lighter green areas represent slightly bullish postures. Well, it turns out the significant trend changes always happen right here. They always happen in the strong bullish areas. That's when the market turns down. And if you think about it, that's always how it works. We don't really know how far it's going to go. We just know that when the stock finally decides to turn around, it's going to be in a bullish area, and we know it's going to turn around. And it's kind of like saying the stock just couldn't go any higher, and so it had to turn around. And that's just the way it is. And it'll stay that way until it finally hits bottom of a significant area, and it's strongly bearish, and then it finally says, I can't go any lower, and it'll turn around. And you can just use that kind of like a guide. It's going to happen that way. So let's talk about what these postures, how they're related. And it turns out that they're all tied to the market forecast indicator. And the market forecast indicator is a proprietary indicator that was created by TD Ameritrade. And it has an output value of 0 to 100, looks like a percent. And there's 3 lines in it. There's a red line, which is referred to as the momentum line, and it's very quick. There's a blue line, which is a little slower. It's called the near-term line, and it's a little less slow than the momentum line. and the green line is the intermediate line. And it turns out they don't actually, TD Ameritrade does not give you an indication of what the aggregation period is for computing this thing. All they're saying is there it is. So I've modified the green line. I've modified this market forecast indicator down below to show where things are changing places. So the white dots represent spots where the intermediate line is does not move less than 2%. If it doesn't, if the move from day to day is less than 2%, nothing happens. It's a white dot. But if it does change to down, you're going to get a red arrow, and if it changed to the upside, you're going to get a green arrow. And as you can see, normally once you get a green, it kind of goes all the way up, or kind of goes in major chunks. Most of the time it goes down pretty fast. So you can compare these dots, and if you look at them and you compare, we're kind of small in here, but you just trust me, it's a 2%. If it's within 2%, that means it's not really doing much. And if it's arrows, it means it's moving. So for each of these spots in here, it's moving more than 2% for each candle move in that range. So the definitions for a bullish posture mean that either the intermediate line, the green line, is above the 80th percentile, in which case you can go up or down. It doesn't matter. So long as it's above that 80th percentile, it's guaranteed to be in a bullish posture zone. And likewise, if it's below the 20th percentile, it's guaranteed to be in a strongly bearish posture zone. So this here is strongly bearish. But between the 80th percentile and the 20th percentile, if the intermediate value is less than 80 but more than 20 and it's going down, that means it's slightly bearish. So that area will be a light green color, as opposed to, in this case here, it'll be a light, if it's between here and there, it's slightly bearish, it'll be a pinkish color. If it decides to turn around, it'll be a dark green, and if it's going back down, it'll be a light green. So once the intermediate line falls below 50 and it's going down, then it's considered to be strongly bearish. So if you look at this area and we zoom in on it, you can see from here down, from this point, which is less than 50, to all the way there, that is going to be strongly bearish up to that point. And before this, it was slightly bearish. And likewise, when it finally turns around, it's below 50, but because it's going up, it's slightly bullish. And eventually, once it gets above 50, then it'll be strongly bullish. So that's how it's actually colored. And that's kind of significant. That's kind of significant because we're taking the valuations from the market forecast line and we're colorizing the background of the chart, and we're just showing that. So it turns out that when you marry up the background color, the background posture representation with the actual bars, you can begin to see that those areas are critical. This is just a continuation of where I left off from part one, and we're still looking at the SPX. We still have the market posture bands shown on the chart. I've stopped I don't show the market forecast indicator at the bottom channel anymore. We're going to zoom in on thing, and the only thing I've done to this chart is add a ribbon. I've added the 10 period hull ribbon and the 20 period hull ribbon. And they're in here, and I added these because James Boyne had brought these up, and he uses these all the time. And they're the interesting thing is he uses them. He looks in here and says, hey, if this area is red, it means the stock could be falling because the 10 hull is less than the 20 hull. And it turns out that when I did this and I was thinking about the bullish and bearish postures and where things happen, I thought, what would happen, and I didn't do it this way, what would happen if I plotted the 15, if I plotted the whole 15, and I don't show it on here, I'm sorry, and I was looking for a reversal, trend reversal in the whole 15, and whenever the posture was strongly bullish, and I got a reversal in the whole 15, I put a white dot on the chart. And if it was strongly bearish, this was a reversal to the downside for a whole 15, I put a white dot. And what happens if it was strongly bearish or slightly bullish and I got a reversal? I put a white dot on the chart. And after I did this, I go, well, this is a pretty interesting phenomenon, because these guys kind of correlate with areas of, I want to make this 2 years. You kind of end up with areas of resistance. In my mind, here's a resistance area. You can see this. This is a very bullish zone in here. You look at it, the price never even touches the 30-day simple moving average, and it's bouncing off of this white dotted line here is the 10-day exponential moving average. It's barely dotting off that. So very strongly bullish area, and occasionally we got some white dots. But if you wanted to go short on your investment, it would probably, as soon as this thing bounced back off of this, you better be prepared to get out of it, because it was really strong. But there are certain cases where I started using those as key points to determine where potential inflections should be in here. And it's uncanny the way they show up. I mean, I was looking for major peaks like this to show when it happened, but it never really came to that. So anyway, this is the way the white dots actually work. So if you have a really strong bullish trend and the 30-day simple moving average never changes to yellow or green, and you get a white dot, it doesn't necessarily mean you should go bearish. But be prepared. If you see this white down arrow, that's a significant clue. And like I've mentioned in the past, the time when this thing goes below the 30-day simple moving average, that's a death cross right there. So be prepared for some significance. But if you start to see areas where there's other white dots and the market has been in a really strong bullish trend, I mean, if you go back and look at this thing from a 3-year standpoint, you can clearly see that you don't quite have as much noise if you're looking at 3 years with weekly bars. So you have way less white dots to work with. So, and you can clearly see it works out pretty well from a weekly standpoint, from a trend standpoint, if you're using weekly bars. So it's important when you're trying to make entry positions, trying to decide what your posture should be on a particular asset, you need to be thinking about what the long-term trend is. And by the long-term trend, I'm thinking you should be using weekly bars to make that those decisions. But once you know what your long-term trend is, then you can start to make decisions about what your short-term trading posture should be. So if you look in this case here, since the first of the year, we can see that we kind of fell off. The 30-day simple moving average is still red. In here, and our price on most occasions, even though it may show a bounce to the upside, it's having a really hard time breaking through the 10-day exponential. And if it does, actually this isn't the 10-day. Since we're on a weekly chart, we're talking the 10-week exponential, but we haven't been able to break through the 10-week the 30-week simple moving average. We haven't been able to do that. So we're still in a serious / significant downtrend. So if you're looking to invest to the long side, you should not be looking at SPX. That's what it's saying to me. This is what it's doing. The trend is bouncing off of the 10-day exponential to the upside. That is your diagonal resistance line. However, last year the bars were clearly bouncing off of the 10-week exponential, and you can see that the significant points in this thing when it really rolled over happened here. This is 7th of February. The white dot showed up before that. And if you look over here, I got to move this guy out of the way. The white dot showed up over here on 4/13 in looks like 2019. So I'm just trying to provide the context. You need to be looking at weekly bars and be able to put your trading cycle, in sync with your long-term trends. So that's kind of the way I look at it from the standpoint of wait a minute, I want to get out of here. How I look at this thing. This is 1 year daily. So that's kind of what I'm thinking about. That's kind of how I see these white dots. And I have other things that I have married to the white dots right now, but initially that's how the white dots came about. Is what can I use to signify critical inflection points in the daily chart? And the answer is you're going to get more white dots on the daily chart because it's more volatile. But as soon as you switch to a weekly chart, so I've gone from 1 year to a weekly chart, you can see that the white dots drop out significantly. So we were only looking at this much here for the last, this is a week, about this much on the previous chart, and we had a whole bunch of white dots, and now I only see one, two, three, four of them. Whereas if you look at these things from the standpoint of a 1 year chart, there's a lot. There's a lot of white dots involved, and there's more noise. So, and that's how I try and keep things straight with regard to where do I enter and where do I exit. So with those thoughts in mind, I'm hoping that presents the context for how I use the white dots on my charts, how I use the up and down arrows to signal the the confirmation points on the chart. And so I think those are critical. So if you're thinking about playing the game in this market, clearly this weekly chart is telling me you need to be thinking about plays to the downside. And obviously the best time to put on a play to the downside is when the chart is up near the 10-day weekly exponential. If it should ever hit this thing here, should ever hit the 30 week, then either it's going to break out madly to the upside, or it's going to reverse and turn around. And to my way of thinking, as long as the Fed keeps raising interest rates, it's going to keep going down. There's one last thing that I wanted to cover with regard to the white dots and the golden cross upward transversals and the death cross indicators. And that's that these symbols or these indications are also available on the watch list. You just have to know your color. The market phase is found here, and the colors we're looking for are found under the weekly percentage gain or the monthly percentage gain. And let's jump to a different watch list, and I'll show you where they're at. So let's jump to the S&P 100. So if we're looking for a white dot, it means we're going to be looking for a blue background color. Pretty simple. If you find a blue background color, it's going to be a white dot. The question is, what kind of white dot is it going to be? If it's black characters, it's going to be a white dot that's signifying a bullish reversal to the upside. If you find a white dot that's blue background with white colors and it's white, it's going to be one to the downside. In this particular case, we are on a daily chart. So if all things that I pick here, this is a daily chart, we're going to see a white dot on the side. If you wanted to see pickups that happened on a weekly chart, look down the monthly gains and look for blue backgrounds in that column, and those refer to changes that are taking place at the weekly aggregations. If you're looking for death cross and golden cross transversals, look for bright green and bright red in the weekly or monthly column. So it's just a question of knowing which color you're at, and there's not that many of them actually. There's we've covered, I think there's probably 2 more, and that's about it that we've got. But pretty much that covers all of those indicators in here. And the real power of the software is being able to look over a top level list and go down the list and look for gains and special considerations that are taking place. So we already know green and red is good. We know what those do, and we know what the blue background does. And I'll discuss the other colors, in other webcasts. And that'll do it for right now.